Most beginner traders only understand one side of the market. They know how to buy. But they never fully learn how traders profit when markets move lower. And once you understand both long positions and short positions, chart analysis becomes much easier to understand. In this tutorial, we're breaking down how both strategies work using simple TradingView examples, beginner-friendly technical analysis, and real market structure concepts used across financial markets. By the end of this video, you'll understand how traders approach bullish and bearish conditions, how to identify stronger setups, and how to avoid common beginner mistakes. If you enjoy clean and beginner-friendly TradingView tutorials focused on real market analysis, consider subscribing to AI Trading Analytics. Let's get into it. A long position simply means buying an asset because you expect the price to move higher over time. This is one of the most common concepts in investing and trading. When investors buy stocks, crypto, ETFs, or other financial assets expecting future growth, they're taking a long position. The goal is simple: buy low, sell higher, and keep the profit from the price difference. Now let's look at how this appears on a TradingView chart. Notice how price reacts multiple times around the same level. That's important because repeated reactions often show strong buyer interest in liquidity near that area. In simple terms, buyers consistently stepped into the market there. That immediately gives the support zone more significance. At the same time, the market structure remains bullish. We can clearly see higher highs and higher lows forming across the chart. That tells us momentum is still favoring buyers. One of the biggest mistakes beginners make is trading against the dominant trend. Professional traders usually prefer aligning with market direction because probability improves when the momentum and structure support the setup. Now notice this upward trend line connecting the lows. This creates additional confluence. Confluence simply means multiple technical signals supporting the same idea. And in technical analysis, the more confirmations a setup has, the more attention traders usually give it. Here we have bullish structure, repeated support reactions, trendline support, and strong bullish candle responses. That combination creates a stronger long setup. Notice the long rejection wick forming near support. This shows buyers aggressively defending the level. Large lower wicks can indicate demand entering the market and absorbing selling pressure. Nothing guarantees price will continue moving higher. Trading is always based on probability, not certainty. But these signals can improve the chances of bullish continuation. Now let's say you decide to enter a long position here. Position sizing and risk management become extremely important. Experienced traders focus heavily on protecting capital because surviving volatility is critical in financial markets. A strong setup means very little without proper risk control. Now let's continue the example. Price starts moving higher. Momentum strengthens. Buyers remain in control. Eventually, price approaches a previous resistance area. Resistance works similarly to support, except sellers historically entered the market around that level. That creates possible overhead supply, and traders begin evaluating whether bullish momentum may start slowing down there. Notice this strong rejection candle forming near resistance. That reaction suggests selling pressure may be returning. For many traders, this becomes a logical take-profit area after a strong upward move. And this is how traders profit from a long position: buy lower, sell higher, and ideally align the trade with momentum, trend direction, liquidity, and market structure. Now let's move to the opposite side of the market: short selling. A short position means profiting from price moving downward. Instead of buying low and selling high, you're effectively selling higher first and buying back lower later. The goal is still to profit from price movement, just in the opposite direction. Short positions are common during bearish market conditions, weak macro trends, negative market sentiment, or broader financial uncertainty. Institutional traders and hedge funds frequently use short exposure for speculation, hedging, and portfolio protection. Now let's look at a TradingView example. Here we can see price approaching a previous resistance and supply zone. This area previously triggered strong selling pressure. And now price is revisiting that same region again. That immediately gets traders paying attention. At the same time, momentum starts weakening. We also notice bearish divergence forming. Bearish divergence happens when price pushes higher while momentum indicators begin weakening underneath. This can signal slowing bullish momentum and possible reversal conditions. Another important detail is this rising wedge pattern forming into resistance. Rising wedges often appear before bearish breakdowns because momentum compresses while buyers gradually lose strength. Then we finally get confirmation. Price breaks below the wedge and forms a lower low. That shift in market structure becomes important because sellers may now be taking control. At this point, many traders begin considering short exposure because the technical structure now supports downside continuation. Good trading is not about randomly guessing direction, it's about waiting for evidence. And here the evidence begins stacking together. We have resistance overhead, bearish divergence, weakening momentum, a wedge breakdown, and a new lower low forming. That creates bearish confluence. Now let's say you decide to enter a short position. Risk management becomes even more important during short side trading. With long positions, losses are limited because an asset can only fall to zero. But during short selling, losses can theoretically continue increasing if price keeps moving higher. That's why professional traders focus heavily on stop losses, controlled position sizing, and strict portfolio exposure rules during volatile market conditions. Now let's continue the setup. Price begins moving lower, sellers gain momentum, and bearish structure starts accelerating. Notice how lower highs and lower lows begin forming consistently. Eventually, price approaches a major support zone. Notice how price previously reacted strongly from this area. That tells traders buyers may potentially re-enter the market there again. And when bearish momentum reaches major support, experienced traders begin evaluating profit-taking opportunities. We also start seeing signs of slowing downside momentum. Candles become less aggressive, wicks increase, and bearish expansion begins weakening. These details matter because markets rarely move in one direction forever. At this point, many traders choose to cover the short position. Covering simply means buying back the borrowed shares and closing the trade, and this is how traders profit from bearish market movement. Not through emotion, but through technical analysis, market structure, momentum, liquidity, and disciplined risk management. Now here's something extremely important beginners need to understand. Long positions and short positions are not about being emotionally bullish or bearish. They are simply tools. Professional traders adapt to changing market conditions. If momentum and structure favor upside continuation, traders may look for long opportunities. If macro conditions weaken and technical structure turns bearish, traders may look for short opportunities. The market itself determines the strategy. Another common beginner mistake is forcing trades during unclear conditions. Not every chart deserves a position. Sometimes the best trade is simply waiting. Professional trading often requires patience far more than constant action. So let's quickly recap. A long position means buying an asset expecting price appreciation. Profit comes from selling higher later. A short position means selling an asset expecting price depreciation. Profit comes from buying it back lower later. Both strategies rely heavily on technical analysis, market structure, liquidity zones, momentum confirmation, and proper risk management. The direction changes, but the core principles remain the same. And once traders understand both sides of the market, chart analysis becomes significantly clearer. If you're serious about improving your technical analysis skills and understanding financial markets, make sure you're subscribed to AI Trading Analytics. New beginner-friendly TradingView tutorials and market analysis videos are uploaded weekly. Thanks for watching, and I'll see you in the next tutorial.